Good afternoon. Thank you all for joining for today's webinar. We'll just wait for a few more people to join in. We'll start the webinar by 12 o'clock, 12:05. So I guess we are good to go. We'll start with today's webinar. Thank you all for joining in for today's webinar. Today we are going to talk about a very interesting and trending topic that you might have the investors might have crossed across. That is NFO, new fund offer. So whenever a fund house launches an NFO, there is a lot of buzz around in the market. You see ads everywhere. You see fund managers talking interviews, discussing about the strategy about the fund and so on. And let's say a lot of billboards too, right? So with so much happening around you, it's quite natural to get carried away and invest in an NFO. But actually, is it a good idea to invest in an NFO? Before we dive deep into this topic, let's actually start with a poll. So when you hear about an NFO or a new fund offer, what is the first thought that actually comes to your mind? So you can just select from this option. One is great opportunity. Second is a new fund means higher risk. And third is some investors would feel like not sure, I need more information. So you can just it's like let us know it's like what is your idea about it and just comment on the chat box regarding your option. Option 1, great opportunity to invest early. 3, not sure, would need some time. Okay, so far like around about 3 people have replied, and it's like it's actually mixed review. Oh, people are typing it. Right. So there is bit of an uncertainty, and there are mixed reviews in that case. So what to start with, I'll do is we'll start with what is actually an NFO. We'll start with the basics. So when a fund manager or the fund asset management company launches a new fund, so in that case, they offer a new fund offer, that is NFO. It opens up for a subscription period of select few days. So the aim is to raise money from buying stocks for their funds portfolio and take it off the ground. The entire new process is called as a new fund offer or an NFO. In a lot of ways, it looks actually like similar to an IPO, and that pushes people to buy in NFO period. But there is no specific advantage as of that. We'll come back to that later, comparing NFO to an IPO. Now, as per regulation in India, the NFO duration cannot be more than 15 days for any mutual fund. And after that NFO period, if the fund is an open-ended fund, it can start accepting monthly investments and new investments and so on. And let's say, for example, if it is a closed-ended fund, then the investor can subscribe to the fund unit only during that NFO period and will have to hold it for that entire duration and so on. So in this case, now you might be wondering, is it actually a good idea to invest in a new mutual fund NFO? Because as of now, you might have already seen a lot of new fund offers coming in. And as we're right now talking, there are already 11 NFOs offers going on in the market. So right now, let's think about that and see it's like, does it suit our risk capacity, our investment framework, and should we actually invest in NFOs? So this is one of the interesting thing that we always see across like every newspaper we see. It's like there are certain datas on a monthly basis, like every year or every month. It's like so far what we have seen is hundreds of NFOs are launched on a calendar year since 2020-21. And this year, at least right now, 112 of funds have already hit the market. So far, there have been 82 NFO launches by this month, which is a lump sum or wholesome amount that brought in was around about 70,000 crores. So what experts attribute to this tick in the NFO launches is whenever there are the market conditions are favorable, when the robust economy outlook is there, that time during this bull phases, the NFOs tend to be one thing that's already out in the market and attract more inflows into the market. So in that case, these are some data points that I wanted to show you guys. So yeah, NFO launched to set a new target this year again. So in this case, if you see again closely, what is the case is the passive investments. The number of passive investments, passive ETFs, index funds that are opened is also very high. So as many as 63 passive schemes, NFOs have been launched in 2024 till date, higher than the 51 schemes that was launched in the 2023. Entire 2023. So among that passive thematic funds, the PSU category saw the highest net inflows despite its relatively small assets under management. Meanwhile, the number of active equity NFOs launched in 2024 till date is actually pegged at 38 or 40 odd against a little over 50 that was launched in 2023. So more importantly, the number is going to continuously rise is what we also expect in. And overall, the industry AUM has grown more than 7-fold in the past decade, rising from 8.3 lakh crores in December 2023 to 61.2 lakhs crores from mid-2024. So despite this surge, what we have seen is passive fund was a go-to place, and active funds compared to active funds, it's dominating in this standoff point in the NFO space. So as of compared to last year, 51 NFOs came in the passive area, whereas until date, there are already 63 NFOs offers in this passive space. The passive funds are on the rise is what we felt. So as I said, it's like comparatively what the data shows is so far there have been approximately 82 new fund offers that have come in, more concentrated around about 40 to 50% in index funds, ETFs, and more actually allocation in sector funds. So right now we are not sure. It's like Harshil is going to be on the call shortly. He'll give you the outlook about is sector fund the right push right now and more about the top three sector funds that has been released recently. So apart from that, what I said was it's like it has actually covered wholesome of 70,000 crores so far. The highest allocation being in the sectoral fund, around about 52,500 crores. So with this data, what we've seen is, as I said, it's like with the bolstered inflows into these equity schemes categorized in the recent month, in the equity mutual fund schemes recorded the highest ever inflow of 34,000 crores, with an NFO contributing around about 9,500 crores in June. And in June, again, it's like what we see, the number has doubled and has been in the range of 14,370 crores and so on. So hence, it's a record-breaking NFO collection, and it's not actually something like a constant thing that's happening. There has been up down whenever the market is in a bull phase. The number of NFOs that came in the market has also been high. So hence, the subscription has also multifoldly increased. So now I'm going to talk about one of the important topic. It's like there are a lot of common myths related to the NFOs or a new fund offers. At times, people simply think it's like, okay, if an NFO is coming, they relate it to an IPO. They might think it's like this is after seeing all the billboards and fancy shining thing. It's like they think it's like this is the NFO or the fund that's going to help out my wealth creation and take me to a multi-bagger thing. But it's like these are the common myths that we face. We'll expand on them each by each. So one thing that comes into people's mind while investing into an NFO is it's related or compared to an IPO. However, these two investment avenues are very fundamentally different, and I'm going to break it down for you. So let's take a closer look at the IPO. So in IPO, a specific company is actually raising funds to achieve its specific goals. So it can be particular objectives such as expansion, debt reduction, or new project expansion. So apart from that, for an IPO for a specific company, the details or the information available for the recent investors are very in detail. All the financials, their business operations, the growth prospectus, and future plans of the company, and so on. Apart from that, one thing that we have to consider is the company share price is determined based on the financial and then the market demand. If there's a higher demand in the market, the company's price tend to rise. So that's the main underlying thing. So if a company performs well, the stock price may soar once listed also. So regarding an NFO, what should you expect? So in contrast, an NFO is a mutual fund that pools money from investors to invest in a variety of securities. So on a specific strategy, here's what an NFO sets apart. Investment approach is, at the time of NFO, the fund does not hold any stocks or underlying assets or securities. The rupees 10 price unit is merely a starting point, whatever you are purchasing an NFO for. And with that, it's like the fund managers would be actually kickstarting with whatever the contributions that comes in within an NFO period. Apart from that, what generally people think is the NAV is at discount. So NAV of a mutual fund isn't influenced by the market demand and so, or is it? It's not actually at par with supply of the stock prices. So one thing is, unlike stock where prices can rise due to increased demand and so on, due to limited availability, mutual fund units are created as needed whenever the funds expand and so on. Thus, demand of the specific mutual fund will not impact the NAV of the specific fund or the NFO offer. The underlying asset of that specific mutual fund would affect the NAV of the same. So apart from that, for this case, like first myth, what are the key common takeaways? The common misconception in the NFOs is like IPO. It will benefit from increased demand and so on. We get a discount units at 10. That's not actually true, since there is no limit to the number of units that can be created. The NAV remains unaffected by the market demand. The NAV would only change based on the underlying asset that is invested in. So that would be the first myth that we wanted to bust in. So second myth, that NFOs are actually cheaper. So one thing would be like, let's say, for example, I have two examples for you. In scenario one, amount invested of 10,000, we bought an NFO at the value of NAV of 10 rupees. Let's say, for example, for the 10,000 investment, what I've done, the units received is around about 1,000. Suppose, for example, if I'm investing in an established mutual fund whose NAV is around about 100. So in that case, let's say, for example, from both the mutual fund folios, like the NAV with 10, that is a new fund offer, and the existing fund that I'm already investing in, grow 10% for 1 month. So what is going to happen? Your value of your investment is going to grow like 1,000 extra. That's going to be 11,000. So it's simple. The value of your investment is the same, no matter what the initial NAV or the units are. So even if you're saying it's like you're getting the NAV at a discount, we are not sure if the underlying stocks or underlying equity they're going to be invested in, it's going to be on discount or so. So what matter is actually the growth of the net asset value or the NAV unit as the underlying stocks or the underlying holdings of the specific mutual fund grows in. So apart from that, one thing is it's like in this sheet I wanted to show you, it's like these are the relevant expense ratio, maximum expense ratio, NFO or a new fund or mutual fund can charge for its investors. So in that case, let's say for example, we'll take an example. In an example, a mutual fund is having a AUM of assets under management of 5,000 crores. So in this case, it's like there are certain benchmarks, right? In that case, the total fee that they can charge is around about 86.15 crores because they fall in the bracket of 1.6% and so. Let's say, for example, if a mutual fund wants to bring in another 500 crores as a offer to the public and bring back money investments, rather than going for a new investments or expanding their existing mutual fund, won't you think it's like they would go for a new fund offer? Because for a smaller scale, they are able to charge a higher expense ratio of 2.25% also. So that is the reason it's like I wanted to show you the comparison. Apart from that, one thing is smaller the AUM, funds with smaller assets under management, they have the flexibility to charge the higher expense ratio. And larger the assets under management are, as the AUM increases, the expense ratio tends to decrease due to economies of scale and so on. So one thing is at the time of an NFO, the fund's AUM is typically small, allowing the asset management company to charge a higher expense ratio and so on. Therefore, even though the net asset value may appear low, the initial price does not necessarily seem to be true or true to the cost value. So initially, it's like to conclude with for the second myth, what I want to say is the initial NAV, the net asset value of an NFO, does not reflect the true cost or the value of the investment. It's crucial to evaluate the expense ratio and the fund's potential for a growth based or an investment strategy of the underlying assets. If you have conviction for the specific sector or theme that you're investing in, if let's say, for example, your risk capacity, if it suits your financial goals and so on, that time it might be a good pick. Apart from that, just thinking it's like NFOs are cheaper on discounted rate, it might not be a good idea. So this is actually example. So these are the top 5 NFOs that had actually come in like last 3-4 months back and so on. So in this itself, you can see it's like what are the difference between the expense ratio of an NFO and it's like, let's say, for example, established fund that we are recommending in. So the difference is huge because with an NFO, there are a lot of costs that are associated with advertising cost, NFO cost, new fund offer. After that, it's like being the small case, they are having the flexibility of going to 2.25% and so on. It's not true like every mutual fund would try to max it out their expense ratio to 2.2% and so on. But generally, it's like seeing the well-established mutual funds. This is the comparison I wanted to talk about. So in the last, actually, Harshil also is going to go through this slide again and will show you it's like in the long-term compounding, how this difference in expense ratio is going to be a great impact on your entire portfolio. So moving to the next myth. Okay, so new NFO does not actually mean it's a better deal or something like that. So why would it be? So if you see, it's like in the below table. So we do not want to assume that new means better returns. The NFO may not be adding anything new to your portfolio, but you may have already established some alternatives in that space. To understand this better, we have this table that is mentioned below. Out of all the 110 NFOs that was launched from Jan 2019 till 30th April 2024, only 6 out of 10 NFOs underperformed. Actually, 62% of the NFOs underperform either the benchmark or Nifty 500 TRI. So 68 funds of the 110 NFOs underperform. That is one thing. Apart from that, only 1 out of these 4 NFOs were in the top quartile. So in short, only 26% of the NFOs were actually ending up in the top performance quartile of this total 80 funds that were there in the 88 funds that were there in the specific sector. So hence, this is the comparison we wanted to show. New doesn't actually mean better. Suppose, for example, let's say, for example, if there's any other theme that's coming in and you have a good conviction, let's say, for example, an international fund that's already you don't have an exposure towards in a portfolio, you know the fund manager, you already have the exposure in, that time, maybe you can think of adding something like an NFO and so. But still, there is something I would like to show you. It's like whether what time you can actually invest in an NFO and what time you can actually avoid it. So 90% of the time, it's actually very better to avoid an NFO. Because one thing is majority of people as you commented in the poll. So one thing is it's like you said you wanted to wait and watch whatever the performance is and so, and then you wanted to invest in an NFO. So one thing is they don't have any track record. A lack of track record makes it very difficult to evaluate the performance of the fund across different market cycles. The risk you take in an NFO is very higher when you go for a fund that has already been around for few years or build a history and so on. Apart from that, there is no meaningful differentiation due to variety of diversified funds available till date. It's rare to find an NFO strategy or approach isn't already available in the established market or established mutual funds. So apart from that, at times there might be certain cases timing may not be right time. Because let's say, for example, we have seen a lot of times it's like whenever the sector is very overvalued and expensive, that time certain AMCs has gone and opened the NFO in that specific sector to pull out and bring in money to that specific NFOs. So we'll cover that also in the later slides. So what about the 10% of time that we think it's like we can invest in an NFO and add it in the portfolio? One thing, as I said, is unique fund strategy. If a fund is going to follow a unique strategy that is currently not available in existing portfolios, that time it might be an opportunity. You can actually read about that, review that, and invest into that. Apart from that, experienced fund manager. Because there is a new fund offer with no underlying portfolio, it might be very hard to analyze the portfolio and the performance of the specific NFO. So in that case, if the fund is managed by an experienced fund manager who has a demonstrated consistent investment approach or investment philosophy and so, and in different market cycle, that time you can actually approach or think about a good opportunity to invest in an NFO. Apart from that, fund category or strategy that benefits from a lower fund size. Suppose, for example, a new fund in small cap category, which has a lower AUM, could have a size advantage compared to an existing small cap fund that is there in the market, because they would have some restriction on allocating certain capital towards the specific stocks in that entire portfolio. Apart from that, a new fund which follows a momentum strategy plus has a lower AUM and so on, at times would be beneficial for certain set of clients whose investment objective would actually suit them. So in this case, these are the two categories that you can think of when investing in an NFO. 90% of the time, it's actually very great. We need to avoid it. 10% of the time, we can think about it and invest, because we need to be aware about what is our investment objective, what are our risk appetite, and let's say, for example, if the underlying assets and all, after thorough research and after having a thorough conviction, we think it's a good time to invest in NFO. It's for sure, it's like that thing. So apart from this, Harshil is going to join in right now to give more market outlook about what NFOs are, and it's like, should you actually invest in NFOs, and what is the point of view from the strategy team? Yeah, I'll pass it on to you, Harshil.
Thanks, Vinayak. You can go on to the next slide. Yeah, so I think you made some very interesting points, right? And all of this is already there, publicly available to us, right? So we're only going to work with public data. We're not working with something that's new, right? You've seen a lot of NFOs come in, and the idea is that, and what you're being told is that NFOs are good for you to invest in. It's a new theme, but it is expensive, right? The expense ratios are quite high on what things have come up. So one or two, you will see some interesting ideas come up. That doesn't mean that it's investment worthy. There are ideas that come up that, yes, maybe you can track, for your future investments. But there was one good point that he was talking about, that only when you see that when there is an increase in prices, or when a theme becomes much more attractive in terms of news, in terms of hype, like say defense, for example, or say energy, for example, you see a lot of people start flowing in money, performance starts coming in, and that backtested performance pushes everybody to go out and start investing more and more, right? But that should not be the case. We've always seen this, that in periods of euphoria, you always see such themes come in. And that becomes a problem for the entire industry, right? Not that the theme is bad, but since euphoria comes in and it pulls up the valuation, it becomes difficult for investors to participate, right? So you look at this particular idea, right? It's a brilliant idea. It's an index fund. It's an index strategy where you have 50% in large, 25 in small, 25 in mid. Now, the selling point here, this is not a recommendation by any chance. This is just for study, right? This is just to see what are the innovative products that are coming up in our mutual fund industry. This is not a recommendation for you to participate in anything, right? I'm making that very clear. This is just to study. So what you see majorly is that when you see a multi-cap fund, there is a cap, there is an active cap on mid and small, right? Now, in periods where valuations are high on the mid and small cap side, you obviously cannot participate in them, and naturally, larger players or flexi cap players would not have much of an allocation towards mid and small, right? But here, when things go in your favor between small and mids, again, multi-cap funds and flexi cap funds have a cap, right? So here you have an index fund where they will always have certain percentage in mids and smalls where you can participate across India's growth story, right? So that is the only good point. So when you're seeing a particular NFO, you see, okay, is it worth for me to even track it? Okay, why should I track it? Okay, I need to track it because I need to see that from a broader index perspective, when I see top with the bottom 50 do extremely well, which means it's a broad-based thing. Valuations are actually starting to go up. Is there an opportunity for me to invest in the top 50? So if you see from a return perspective, if you see 15 years, right? This is what we look at. We do not look at 1 year. We do not look at 3 years. We straight away look beyond 5 years, beyond 10 years, beyond 15 years, right? So beyond 15 years, this category, right, has delivered somewhere between 16 to 16.5%, where you see the top 50, right? The top 50 has gone and delivered somewhere between 13.5. So there is a good 2.5% sort of outperformance, 3% sort of outperformance that's come, right? So when you have this sort of an idea, you should know why that can this idea suit me, number one. Second, how has this idea done before, and does it make sense right now? If it does not make sense right now, shelf and move on. Keep it on track, but move on from it. That is what we do here. And see, bucket it. So the top 50 does this much, the bottom 50 does this much, right? That's what we look at. You can go to the next one. Right. Now, this is one of the most popular themes that is happening right now, defense, right? So if you see, there's a good story here. There's a very nice story on 1947 to 62, 62 to 85, 85 to 2000, 85 to 2000, defense acquisitions of large platforms from countries such as Russia, France, and you saw a lot of growth coming in on R&D. Today, what has happened is you see defense sector has evolved towards policies supporting domestic manufacturing. The problem with this idea is that valuations in this space are extremely high. Extremely high. It's not that it is high, it's extremely high, right? A lot of public sector companies are trading at absurd valuations. And now when you have a fund like this, and when more and more funds, more and more money goes into such funds, naturally they will have to go and start buying more and more of the same companies at a higher valuation, right? So the chances and the probability of you not making future returns is very high. Right. So this is a good theme. There's an innovative theme that has come out, right? We never had such opportunities to participate in such themes. And now we have an actual fund that we can use to participate, right? But is it the right time to invest in such themes from a basket approach? My sense is no. Right. This is something that investors can say, okay, we need to track this, right? So we had exposure in the in defense via the public sector funds, and now nothing of it is there on our book. So it's a good base to form your judgment on. It's a good base to get knowledge and information on. But ultimately, that decision should be based objectively, seeing what the valuations are and whether further growth can come based on what you're paying for these particular businesses. Energy is another theme which is very interesting for us. Yes, no doubt, if India has to become a superpower, your backbone, which is energy and energy efficiency, has to be extremely high. And we are large consumers of electricity and energy. So you're already seeing, right? So when you read the newspaper, you see so many articles on how we are hitting all-time high power consumption. And this is our backbone for industrial revolution to take place, manufacturing revolution to take place. This is a very, very good theme for investors to look at, but from a long-term perspective at the right price, right? So these are just examples we've taken from an entire list of NFOs that have come in the entire year. We've just taken a few. There are so many that that we do have a review on, but some interesting as case studies alone is what we're presenting. Nothing is a recommendation, nothing of that sort. It's just case studies. So now we'll open the floor for Q&A. Whatever questions you have, please put in the chat box and we'll do our best to address it. And if there's any slide that you want Vinayak to go through back again, we can do that as well.
Harshil, I would actually request you to go through this slide on this expense ratio comparison. Yeah.
Okay, now this, right? So we've just taken some examples in each of the categories where there have been NFOs, right? Now, expense ratio, which is a very said about topic on social media, and it somehow drives your decision, your ability to take a particular decision, which should not be the case. Like, so for example, we always like to go towards track records. We always like to go towards fund managers and partner with fund managers who have that experience to they've weathered through market cycles, so they know what to do with it. So for example, right, when we are looking at large cap oriented focus funds with more and more NFOs coming in, you're seeing because they're smaller funds, you'll obviously see their expense ratio very high, right? So we always give time for them to build a particular portfolio. How can you invest in an NFO when you don't know what the underlying is going to be? See, when we manage the PMS, we take some 6-8 months for us to build the whole portfolio. So naturally, any fund manager out there would take some 3-4 months, 5-6 months to build their entire portfolio, and only then that portfolio start working sort of for them. So we always like to go towards experienced players. For example, if you see more and more flexi cap funds coming out as NFOs, the expense ratio is 2.8%, but the flexi caps that we are already looking at, they are already having a big track record. They are already they already have a track record of performance. They already have track record of the fund manager coming in, giving out his view. The investment philosophy is set, portfolio constructions are set. Naturally, that is a better bet than something that is very new, not even built to scratch, right? So we have to give them some time. So whenever there is an interesting theme, we always give time. We never subscribe to any NFO. We always give some time, let them build it for it is 8 to 12 months, and only then take a call of how the quality of the portfolio is and whether it is in line with the fund manager's philosophy. Second, whether it is in line with what we think of what an investor who partners with us should do, right? Based on their goals, based on their risk profiles, and only then take that call. So the idea is that people want to go towards direct, but the whole point is that when you straight away do an NFO, you are not seeing all of this. You just see back tested returns and then take that call to say, yes, I want to go out and do it. So if you see anywhere else here, right, there is nothing that is juicy enough for you to say, no, I don't want to miss this opportunity. I don't want to wait on the sideline and go for it right now. There's nothing that comes on to say, no, I should do it. You can obviously wait, take a lot of time for you to take. You'll obviously keep on getting more and more solutions, more and more innovative products. We are growing, our market is growing, we are maturing as investors. So naturally, you will have more and more products coming in. More and more products will definitely come in. So you're not going to miss out on anything. Don't think that you're missing out on something. That's what I would say. So I think we're having questions. So if one invests in NFOs as there is no benefits, then how will the fund start to buy initially? Won't they be describing the percentage of each stock or sector in scheme document? Well, no, they don't tell you what stock they are buying. They will just give you a pure philosophy of what they want to invest in. That's show the energy slide. One second. That's the reason of why we put that. It's a theme, right? So they're not going to tell you where they look here, right? They are just telling you what they want to do. And how they would want to invest. They will not tell you where they are investing, how we want to invest within these parts. This is our universe and this is what we want to do. How when nobody invests? No, there will always be institutions who will support, right? There will always be the sponsor who supports. So there will always be a buying small amount of ticket that goes in for them to start the NFO. the sponsor will do it. They will get more money from institutions, and then automatically they will start that fund and start gathering AUM, right? But the whole point, they will not, in no NFO at the day one when they launch it, will they, or when they are presenting it before the NFO, will they tell you which stock they want to buy? And they will give you a universe. They will give you a universe that to say, we will invest here. Vinayak, can you also put the number which is on the next slide?
Yeah, just 1 second.
Last slide, please. Just show the last slide. Somebody has commented, I want to see the last slide.
Yeah.
Yeah. So they will always give you know that they will give you where they want to invest in, and they will give you some data points on what you know why they have come up with the fund, uh, uh, and that's their market. That's the universe in which they want to invest. Is it a good idea to sell a mutual fund when rolling rate of return we have got is more than long-term average return on the same, say 10-year? See, uh, when you're taking a decision, right, please work with your advisor. Please work with somebody who has that sort of experience. Right? Today, rolling return is widely sold on social media to say, don't look at that, look at this. There are methods on how you should see this thing. See, these are all for people who are on the on the research side, on the strategy side, to say what has been happening, what went right, what went wrong. Right, that number indicates this: what went right, what went wrong. What decision you have to take by yourself is to maintain consistency in making sure that your savings habit is leading into an investing habit. That is what you should be doing, right? When the rolling rate is obviously it's higher in the previous ones, which means market has done extremely well. Naturally, the fund has done extremely well. There's no need for you to compare and see. Every cycle there will be a different rolling rate that sort of comes out to you. Yes, it's an indicator of euphoria. There's an indicator of performance, good performance coming in, but you cannot see front to back and then again back to front. So don't try to do that. Just have the numbers ready in your hand, and be aware that okay, this has been a time that has been extremely good. Where do I need to channel my savings here? We have always taken a multi-asset sort of approach, and wherever we have found that valuations are extremely high, we have taken that call to divert incremental savings towards asset classes that are cheap. That's what we have done. And at Milestones2Wealth also, you will have that sort of experience with us, where we will only do based on your risk profile. We will only do based on setting whatever milestone that you are sort of setting for yourself. See, and mutual fund per se, they have not had that bad of quality issues unless and until there's an actual problem. See, because you're taking a basket approach, there the downside that comes to you is not very large compared to that of a stock, right? So always remember that that's always a better bet than you going towards a direct stock sort of an approach. Okay, I took a personal loan for buying a real estate, but later it was cancelled and the money is sitting idle in my bank account. I'm getting somewhere around 4% from savings while I'm paying 10.5% for my personal loan. So what should I be doing not to be in a loss? It has been around 4 months. So I would suggest, I think Vinayak, you can have a one-on-one later after this. So do put in
Yes.
your number and Vinayak will help you out to see, where your finances are, what your expenses are, what you're able to save, and it's a good case, but we will take it one on one. So you can just put in your number and Vinayak will get in touch with you.
Um, Harshil, bro, there's one question in the Q&A section.
I've invested some amount like FD in a few NFOs with hope it'll work near it. See, when you're looking at FD, right? FD for you is meant, for a very safe instrument that you don't want to touch. This is money that you just want it to be there, and sudden one day use it for some other cause or something like that. It's not for returns, though you want to beat it, but it's meant for another use case, right? Mutual fund is meant for financial assets, right? Within that is your FD and your mutual fund. Mutual fund is meant for another case, and FD is meant for another case, right? So I don't know what your current finances uh, are, that you, whether you should have chosen FD or whether you should have chosen an NFO. Right? Now NFO, the thing is, again, you don't know what the portfolio is. You don't know what they're investing in the first couple of months. So how can you take a blind bet? When we were having this discussion internally with Shamshar also, I was saying, how can you marry a bride without seeing her, right? And he asked us that straight away, will you do it? Vinayak said no straight away, right? So how can you take the decision without seeing the portfolio? So you have, of course, have to see, how it performs, how it's constructed, why it is constructed that way. That's what we look at, and uh, 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 more and more money keeps going into sectoral themes. More and more money keeps going into innovative index funds. So you need to see how things play out, because it's you're taking a blind bet, right? And that's not healthy for anybody, because you're taking a blind bet. So NFOs will keep coming out as long as there's demand for it. So as long as you have more and more as long as more and more investors keep participating in NFOs, more NFOs will keep coming out. It's like IPO, no? One IPO does well, 10 IPOs will come out. Why does an IPO come out? Why does I think there was one slide, right, where you were telling why do IPOs come out? So they want to utilize it. They either want to repay their debt, or they want to repay their debt. Either they want to raise it for, or they want to sell off some stake, or for capital expansion and all that, working capital and all that stuff. When a promoter is selling at a high valuation, he benefits out of it, right? When there are more NFOs, AMC benefits out of it. The expense ratio is very high. So as long as there's demand, as long as you participate in it, naturally there'll be more and more coming out. So in NFO, there is no discount in NAV. There's no discount. It's either 10 rupees or 100 rupees. No, it's 10 rupees. It's a starting NAV, right? There's no discount. There's nothing. It's like, If you're going to a mall and you go to lifestyle or you go somewhere and in that cart you have jeans, you have shirt, you have everything, and the value of that cart is some 10 rupees, that 10 rupees is what you're buying. So you know inside there is 1 pant 2,500 rupees worth, you don't need to buy. It's very expensive, you can get it later also, but you, since it's an NFO, you're compelled to, it's compulsory for you to participate and buy something, so you do it because you raised money and you got money. Exactly. No. NAV is the net asset value. It is the value of the particular basket. That's why I gave this example. Right? You go to a mall, you go take a cart, you put whatever you want to before buying. Right? The value of that cart is what is starting NAV. So let's say you hold the cart, you don't do anything. Suddenly the lifestyle gives you discount. You're able to buy it cheap. Ultimately, you benefit, right? So there is a starting NAV that is always 10 rupees. They create units based on that particular 10 rupees NAV. They create it. Is there an MF which invests in unlisted startups? No. That will come under AIF category, not mutual fund. Mutual fund will always do what is listed and what is readily available. So there will not be unlisted startups come in AIF category. But I find that you have, you want to keep on taking more and more risk. And I see a lot of just regarding unlisted, right? There is nowadays the banks also are selling unlisted securities to their depositors. How will you get an exit if you choose to decide, if you do decide to invest in unlisted shares, and there's a minimum ticket size that they are putting on top of you, right? How will you decide to who's the person who's going to buy your shares when if it does not get listed? There is no exit for you. So I see this pattern more and more also with how the bankers are selling off. They're trying to get a good commission of the unlisted shares as well. There's no need for you to participate. How will you exit then? Let's say you put 10 lakhs and you don't get an exit. Who will buy those shares? Nobody will buy. And they are not priced properly also. So you don't know, it's completely gray, right? The gray market. The reason why gray market price goes is because somebody is having more quantity to determine what is the price. It's not fair, basically. There's no fair pricing mechanism, unlike listed. Is there any value to find the intrinsic value of the portfolio of an MF compared with NAV? See, the NAV calculation itself includes all the expenses and the cost of running the particular fund, right? That's what you get in your expense ratio. So you can put in that effort to understand what they own and what the intrinsic value of that of what they own is. But apart from that, there's no need for you to project the NAV. Honestly, there's no need for you to project because you don't know what most expenses are, right? Of running the fund and all of that, right? You take the NAV, right? You can try to find the intrinsic value of the companies that they invest in, which is like your stocks only. But again, intrinsic value, look, they are all Excel. honestly, they are all Excel numbers, and you need good amount of business experience and knowledge. That's why we back fund managers who have experience, who have been through multiple phases, who have seen things, who have done good due diligence and analysis, and been objective in what they should own and how much of it they should own. These concepts of intrinsic value, all that is very it's a very good selling point on Twitter, on everywhere, right? They make it sound easy to you, but it's not easy. It takes experience for you to know what its value. So take for example, right? When you go and buy a branded shirt, right? You're overpaying for that particular shirt. Shirts that get made in Tirupur, you're overpaying, right? So you know what the cost of it is to make it, and you know what the cost that they are selling it at, and you know that it's not worth this price. I'll rather wait for a discount, or I'll buy it straight from other people, right? So that is what fund managers are actually doing. They have tremendous amount of experience. They've put in tremendous amount of work to understand how industries have developed, how businesses have grown, what it takes for a business to grow, how does the future look like, which itself is somewhat of an estimate, right? So everything is based on estimates only. So you have to be objective, you have to be right. It's fairly right, and in what you should go out and assume and work on that conviction. So that's what it takes for intrinsic value. From your slides, I learned that a multi-cap index is performing better than actively managed funds. Is it better to go for a multi-cap index strategy than an actively managed strategy? I will always tell you to go for active, because passive in India, passive everywhere, right, is backward looking. Performance comes into the index the name comes into the index after the performance has come. So for example, yesterday Trent and BEL are coming into Nifty 50 index. The performance has already come, you know what the stock price is, right? So basically the index is becoming more and more expensive, right? So you already know. So passive and indexes are backward looking. However, tactical allocation towards passive is very good. Some sectors and themes where the active manager will not be able to take an overweight on, it should complement. Some strategies are very good on smart strategies are very good, which can complement your active. Always look for a complement and don't look for a what do you say? Don't look to replace it. Just always look for complements. OP, can you also put the conclave details in the comment box? Okay, done. That one, and for review also you can put the link here. Okay. So as an investor, how can I know if the mutual fund scheme in which I invest in, investing in stocks that are fair or undervalued stocks, and not buying that we are doing? We take proper quality metrics that's done. We see what the valuation is. We take all sorts of numbers, and only then see if if it fits within a particular risk profile or not. And if it fits within your risk profile, definitely it'll come to you. But the whole point is that the work that an investor should do, a saver in India should do, is to be consistent and be disciplined. That's the job of a saver in India. Right. That's why we have created such models where our role itself is entirely on the mutual fund research side, where a lot of work goes into understanding what you're talking about fair value, right? A lot of work goes into understanding whether the mutual fund scheme is expensive, cheap, not cheap, and then is it investment worthy with the quality? that it has to offer, and only then make decisions. So that's one level. Second level for us is getting in touch with their team, understanding what they are doing, how they are doing things, whether it's in line with our philosophy, not in line with our philosophy. That's the second. Third is to track whether they are actually going ahead with their philosophy, and are they actually walking the talk, right? Then only it comes into our system based on their experience, everything. Based on their experience, how they're able to manage, and whether through multiple conditions, what they've done in the past, how they're looking for the future. That after that only we take that call to invest in a particular mutual fund scheme. We are fundamentally, Milestones2Wealth is fundamentally a behavior oriented program. It's not a buy or sell recommendation sort of program. We want every investor to be able to save 1 crore. See, for an investor today in India, we work with moderate expectations for returns. Somebody doing 30 to 50,000 sort of SIP can, at growing at 9 to 12%, which is a very good rate. It takes them 8 to 10 years to get to 1 crore. Right? I'll put a question to you. If it takes you 8 to 10 years to get to a crore, what happens in the next 10 years? And this is all public data, and I have tremendous respect for people who are actually putting this data out. What happens after the next 10 years, where you just be consistent and go about saving money with moderate return expectation, not to run towards a fund that's doing well or a stock that's doing well? What do you think will be the next 10 years? Okay, no comment is coming. It will be 5 crores, yeah. It will be 5 crores. So basically, when we set a target, say you should be able to save 1 crore, we are actually setting you up for a target of 5 crores. And we have to take it slow. We have to take it step by step. Start off with a small 5, 10, 15 lakh sort of target, then help you save 50, 25, 50 lakhs. And then automatically you will know the game of, what it takes for you to save a crore. And we are working with multiple investors here who have specific milestones, and we work only according to that particular milestone. See, what it takes for a 5 lakh, 10 lakh, 15 lakh milestone is very difficult than that of a 1 crore milestone, because it's hard in the initial days to set a particular habit and get you consistent. That's the whole point. So you please don't think of metrics and all of that. Don't spoil your health and mind thinking all of these things. You just think of being consistent, what it takes to have and be disciplined. Thank you, sir. I'll convey your regards to Abhishek as well. Thank you so much. So we are coming up with a physical meet. It's the second time that we're doing Milestones2Wealth Conclave. It will be in Chennai from 9 a.m. to 5 p.m. It will be it is in Madras Management Association. It's on Mount Road. So we will dive deeper into personal finance, equity research, mutual funds. There'll be a lot of programs. There'll be a lot of talks. We do have guests also coming in, and the registration fee is 2,500. So we're still open, so you do look to register for that. It's a physical meet, so it will be great for you to meet the team, see the team. If you're lucky, also you can get to meet Shamsa as well. But you'll get to meet the whole team. You'll understand the scope of this operation, and you'll be able to appreciate the fact that yes, we are working with each and every single investor for them. Right? There's a lot of work that goes one-on-one with them. Yes, 5 to 6 crore. Yes, you're right. Which means that by the end of the 20th year, you're adding a crore every year, right? What is the difference on joining during NFO and after launch? Can you buy NFO after launch? No. See, again, you're mistaking the the NAV, which is what you're getting, to stock price, right? It's not the same. IPO is alag. That is different. That is a stock. NFO is basically AMC raising money, right, to invest in a particular thematic basket or an idea, right? If you're doing a multi-cap, then flexi-cap sort of category will be. So once they, so there will be, so you've noticed this, right, that the NFO is open from this period to this period. From this period to this period, it's only getting, they're raising money from investors, they're raising money from institutions. They've opened it for retail. Whoever wants to participate will start getting. At the end of the NFO, they will, after it gets launched, then that's when they will start. They will give you the units, and after that is when it starts getting, the NAV will start getting traded every day. So that's when the performance of what they buy starts getting reflected into the NAV. So let's say, for example, so this was real Birla PSU, right? Which is, if you go to Grow and Zerodha, it's one of the best performing, right? You see the NFO chart, you will note 10 rupees had gone down, and after that is when it started to do extremely well. So for somebody who invested in the NFO, lost money for some time after COVID, and then it did extremely well. Right. After, since we were very big advocates of the public sector space, and you would have seen Shamsur also speak so much at that point for public sector, we were doing and investing in public sector based on risk profile. Right. This was very much after when the construct was done and the clear-cut strategies were made. That's when we started partnering with them. So during is when you get at 10 rupees. After is when the NAV keeps going up and down, and that's where your participate. Don't treat this as IPO. Do not treat this as IPO. So I think we have couple of more minutes for a couple of more questions. So we'll close at 1:05. So we'll keep the floor open for another 2 minutes. The question saying, will you take on Zerodha AMC funds? We track all funds. We review every one of them, but we cannot comment on what we would take, what we would not take. But we review and track everything, and majorly the index. So, but we have a track on everything. And thank you all for joining in on Saturday afternoon. If you're not on the program, get onto the program, send us a hi, and we'll get in touch with you. Milestones2Wealth, again, is more of a behavior-oriented program. Our job and our objective is to get every investor that we work with to 1 crore target, and then from there on, you know how the math works. Okay. Done. Thank you so much for your time. Have a great weekend ahead.
Thank you, everyone, for joining.